Hey, what's up guys? Dustin Heiner here, and I want to share with you about the capital gains rate and the taxes that you're going to get as a real estate investor. See, now let me quickly tell you about the capital gains taxes versus regular income tax. Now, here is what's so funny. We actually get charged a tax when we are making money. It almost feels like a penalty. So, if you're working a job, you're getting taxed at a certain level or a certain percentage. If you buy an investment property like we do, we're investors in real estate, we buy one rental property, we get taxed at much less than we were if we were working a JOB, that just over broke job. And your earned income taxes will be higher than your capital gains taxes. And what's interesting is it could even be double. Right now, currently the capital gains taxes is around 15%, which I love. I think it's fantastic because all my rental properties, I get taxed 15% on the money that makes. Now, if you working that just over broke job, you get penalized so much more from working a job. I think the base for the federal is about 28%. I think that's right around the base that you start getting taxed at if you're working that just over broke job. Now, it could be as high as like 40%, 45%. It's crazy how much money can be taken out of taxes. And that's another reason why I love investing in real estate. Obviously, passive income, making $250 a month in passive income, having the tenants pay off my mortgage and pay all my expenses. Among all those great things, another one is the tax benefits that I have when I invest in just one rental property. Now, the way capital gains works on your rental property, it basically works like this. If you buy a house at a certain price, and it appreciates over time. Like the value goes up over time. What's great is you are only taxed on that increase. You're not taxed on, let's say you buy a house for $200,000. It appreciates to $300,000. You're not taxed on the $300,000 total. You're taxed on the increase, so the $100,000 more. But there's a lot of things in order to get out of the taxes as well as to figure out how to pay it right. Now, I will absolutely say I'm not an accountant. In fact, I'm just relaying to you things that I've talked to my accountant and what they've relayed to me. I literally, and this is what I love about real estate, I buy a property, I have other people do the work. And this is another great reason about having real estate is I work so little. My accountants, I pay them to do the work. My property managers, my realtors, my accountants, like everybody, they do all the work for me and I just pay them. But here's the great thing. I don't actually pay them. My tenants pay them. And the reason why I say that is because I actually account for all those expenses. So everything from my accountants to my property managers, my realtors, inspectors, everybody, I count those as expenses, but then I make sure I rent the property for more, and that passive income, which should be, and you've always heard me say this, $250 or more in passive income from every single property. When you do that, you're going to be making money. Now, I account for the cost of my accountant. I literally just give them all of my paperwork and they do all the work. I don't even want to know what they do, let alone actually do anything with my accounting. I don't want to do any books. In fact, if you guys know me, I'm really not good with numbers. Like I'm very, very not good with numbers. In fact, numbers to me, when I do accounting, it literally goes in my brain. Actually, not just accounting, literally all numbers. You guys, everybody listening, you guys are and watching this, you're much smarter than me. That number goes in my brain and it literally disappears. Like it just floats away. But the beautiful thing about real estate rental properties is that even though I am horrible at math, like I'm really, really bad at math, I pay somebody else. In fact, my tenants pay them to actually do the business for me and run the business, do the accounting and everything. So this is what I do. I literally give all my paperwork to my accountant. They run all the numbers. They do everything. So talk to your accountant to figure out exactly how to best utilize all this information on taxes, as well as getting your depreciation, capital gains, and all that sort of stuff. I'm just going to give you some tips that will help you go as you talk to your accountant. How can I get around this tax? Now, let me get into a little bit more on how the capital gains tax works on a rental property. Now, when you buy one rental property, you would say, let's make it easy numbers. $100,000, you buy the house for $100,000, but then you have other expenses like closing costs. You remodel, you fix it up, any other fees, any lender fees, additions, all that sort of stuff. Every single expense that goes into the property, you add that on. Let's say from even closing costs, paying your mortgage fees, all that sort of stuff, you add everything in and you have a total of $50,000 that you put extra into the property, fixing it up, painting the walls, all that sort of stuff. So you're into the property $150,000. Now, after that $150,000, you go and sell it for $200,000. Well, that $50,000 increase from $150,000 to $200,000, only that $50,000 is what you are being taxed on. Isn't that fantastic? So it's not the entire value. You actually deduct all of your expenses. Now, all those expenses, you literally account for everything. Even your business expenses can be written off in your capital gains rate taxes, because what happens is you're running your business, and that's a capital gains type business. Your earned income is where you work an hour and then you get taxed for that 1 hour that you got paid. Capital gains is basically seen as a business by the IRS. So what they want to do is they want to tax you at a lower rate. Currently, what's great rate right now, it's 15% is the capital gains rate. It's so amazing, that's so low. So if you make $100,000, you're only going to be paying $15,000, as opposed to if you are paying income taxes, like you work an hour, you get paid money. If you make $100,000 in income tax, you're going to be paying about 30%, give or take. It might be higher or lower depending on what your write-offs are, but you might be paying $30,000 as opposed to $15,000. It could be as high as 40% or 45%. It could be as high as that. It's crazy how much more taxes you get. Now, as an investor, as a real estate investor, it's so amazing that we actually have the ability to get taxed at a lower rate. Now, let me give you some ideas, because a lot of people ask me, hey, Dustin, you coach a lot of people, showing them how to buy rental properties, make money in passive income, but how do we make sure that we pay less in taxes? Well, what is super amazing is as you are having one business, you have one rental property, that's basically one business that you have. That business now has so many tax deductions. Here's a great one. One of my favorite ones. In fact, I'm going to create a whole brand new video all about this because it's so amazing, is depreciation. Depreciation is fantastic. In fact, people say, actually, just somebody today, I was working out at the gym, we were talking about real estate, and he said, don't you get paid a lot of taxes? And I said, no, I actually don't. It's crazy how little I pay in taxes because of depreciation. So let me explain it to you like this. If you have a house that you bought for $100,000, you're going to depreciate that over 27.5 years. Now, if you made $100,000 in profit, if you depreciated that out over the 27.5 years, it will look like the IRS, in their eyes, like you made maybe $95,000 instead of $100,000. Or if you have more properties and more value, maybe $90,000 or $85,000. So in the IRS's eyes, they're saying, hey, you know what, Dustin? He only made $85,000 because of depreciation. So I love depreciation. Now, the caveat is, though, with depreciation, this is the reason why I bring it up. When you pay your capital gains tax rate and you're paying your taxes over and over again, you're depreciating that out. So you're actually paying less in taxes because of depreciation. The downside, I don't say downside, but something you got to watch out for. When you sell the property, the IRS recoups all that depreciation. Not you're going to get all tax all at once, but you have to watch out for it and talk to your accountant. Say, I'm selling this house. It's a rental property. Now, I'll give you in just a couple seconds. Watch this a little bit longer. I'll show you how to actually get out of that if you can. But what you do is you say, I'm going to sell this house, but I have all this depreciation. How much am I going to be paying back in taxes to catch up with that depreciation? Now, I would say there's a 1031 exchange. I'm just giving you so much stuff. There's a 1031 exchange. This is fantastic that you don't even have to worry about that depreciation. When you sell a house, you transition that property, that money, into a brand new property. You defer your taxes. Oh my goodness, it's so brilliant. Check in the description for my entire video on the 1031 exchange and how you can absolutely use it, as well as the depreciation video. You're gonna have to watch both of those. But here's a great thing. Talk to your accountant. Your accountant's gonna know exactly how to do everything in that. Now, I did say that I wanted to give you a quick way to get out of having the capital gains, because that's a question I get all the time from everybody is, how do I get out of paying capital gains? I have a rental property and I'm not living in it. How do I actually get out of paying that capital gains? Well, I'll be completely honest, it's going to be very, very hard to get out, but there's a couple of different ways. Number one, like I said, the 1031 exchange, you get out of paying that capital gains. In fact, well, it's not necessarily getting out of it, you're deferring it. You're putting it off for a later date when you actually do sell it. Another thing that you can do, if you live anywhere near close to it, you can literally move into that property and live in it for, I want to say it's 2 years. It might be 1 year. I'm not really exactly sure how long it's going to be. But as long as you live in it, I want to say it's 2 years, and then you sell it, you don't have to pay that capital gains tax because it's seen as your personal residence. So let's say you have a house that's worth $1 million and it's a rental property. Like, man, I don't want to pay all that much money in taxes. If you go and move into that property and live in there for 2 years, then you possibly can get that written off. Again, I'm not an accountant. I'm definitely not an accountant, so don't take my word for it. Talk to your accountant. They're going to actually give you the right way to actually do everything. And when you're thinking about your capital gains tax that you're going to have to pay from your rental properties, think about those certain things like depreciation, 1031 exchange, possibly living in that property so you don't have to pay the taxes. But you guys are awesome. I really appreciate you being here. Watch this video, and I'll see you guys in the next one.